Welcome back to another edition of The Explainer. I am so incredibly pumped you're hanging out with us today because honestly, we're breaking down some absolutely game-changing concepts. If you've ever felt totally overwhelmed by the technicals, or let's be real, if you feel like your own mindset is the main thing holding you back from real consistency in the markets, you are in exactly the right place. Today, we're diving deep into the critical mindset shifts and technical strategies from day 13 of the Trades by Sight ICC course. We're going to strip away all the noise and look at exactly how mastering your psychology directly, and I mean directly, translates to executing massive, life-changing trades.
But hey, before we get completely into the weeds here, let's run through a few quick community announcements. First off, a huge welcome to the ICCMAFIA AI community. To help you guys out on your journey, there's a totally free infographic available for you, as well as a free trading journal to help track your progress. You can grab all of these awesome resources by visiting mrwalleast.github.io/ICCMAFIA. And of course, full source credit goes to Trades by Sai for the phenomenal material we are unpacking today. Okay, let's jump right into it.
So here is our roadmap for today's explainer. First, why you should absolutely keep your 9-to-5 job. Second, market positioning, using a really fun party analogy. Third, redefining stop losses. And finally, we're going to break down an $8.5 million Solana trade.
All right, section 1, and this one might actually ruffle some feathers out there. Keep your 9-to-5 job.
Look, the trading industry is absolutely full of these flashy gurus telling you to just quit your job tomorrow and, trade from a beach in Bali. But Trades by Saya completely flips this narrative on its head. Think about it. If you're trading to pay rent by the end of the week, you are operating in a state of crazy high stress. When you literally need the market to hand you money just to survive, you force decisions. You start seeing setups that, well, aren't actually there. On the flip side, when you trade with dedicated risk capital, money you've saved up precisely because you have the steady, reliable income of a 9-to-5 job, you trade with a low-stress, crystal-clear mind. You have the luxury of just sitting back and waiting for the market to come to you.
Actually, listen to this exact quote from the source material. Please don't go in risking your last dollars. You don't want to trade your way out of your job. Desperation is literally the enemy of strategy. If you deposit a few $100 with the grand plan of flipping it fast so you can dramatically quit your job next Tuesday, you're financially desperate. And trust me, the market will punish that for sure. Keeping your job lets you treat trading like a calculated strategic investment rather than a desperate late-night gamble. So what's the actual practical application here? Well, Trades by Sai reckons building up a baseline risk capital of around $2,000 to $3,000 while you're learning the ropes. By working your job and saving this capital on the side, you put yourself in a position to properly calculate your risk. Think about it like this. If you aim for a consistent 1-to-3 risk-to-reward ratio, say risking $100 to make $300 or $400, you only need 2 really solid trades a week to match a typical weekly paycheck. You don't need 20 trades, you literally just need 2. And having that steady 9-to-5 income, that gives you the ultimate patience to just wait for those 2 perfect setups. Which brings us right into section 2. Market positioning. And we're going to use a really relatable, real-world analogy to make sense of this. Okay, imagine 2 people heading out for a wild weekend. Person A only has their last $100 to their name. They go out, blow it all on overpriced drinks, and wake up stressed out and completely broke. Now look at person B. Person B also has $100, but instead of rushing out immediately, they choose to grind, work an extra week, and now they have $200. When person B goes out and drops $100 on an epic night, they still have $100 left over. They have choices. They aren't trapped. In trading, rushing into a setup with limited capital or poor timing is exactly like person A going broke at the party. Patience, waiting for that right structural setup, that makes you person B.
So, the absolutely crucial takeaway here is this. Options equal power. Period. When you wait for a great entry and position yourself correctly in the market from the start, you instantly gain tactical leverage. If the trade moves in your favor, you now have the power to make choices. You can confidently scale out, take some partial profits, or you can comfortably hold the rest of the position through minor market fluctuations without breaking a sweat. Why? Because your overall position is so incredibly strong. A bad position forces you to panic. A good position gives you the power to dictate the terms.
Let's transition to section 3, where we actually apply all this psychology directly to the charts. We're talking about how stop losses invalidate trends. I really want you to focus on this definition because it's a game changer.
For most novice traders, a stop loss is kind of just this arbitrary safety net, right? Or maybe a random percentage of their account they're okay with losing. But Trades by Sai redefines the stop loss entirely. A stop loss is the exact price point on the chart where your specific trade idea and the overall trend you're betting on are mathematically proven to be incorrect. It's an invalidation line. Honestly, if price hits your stop loss, you shouldn't be mad. You should be grateful because the market just definitively told you, hey, the trend has changed. So how do we actually build this into mechanical, everyday execution? It's a super simple 3-step process. First, you identify the current trend. Let's say it's a downtrend. Second, you find the clear lower high. That's the peak where sellers previously proved they were in total control. Third, and this is the most important part, you place your stop loss just past that lower high. Why? Because if the price breaks above that lower high, the downtrend is structurally broken. The sellers lost control. You only want to exit the trade if the trend completely reverses and invalidates your original hypothesis. This completely removes all that pesky motion from your risk management. Okay, now for the grand finale. Section 4. We're taking all of this, the patience, the positioning, the strict invalidation rules, and looking at a massive, real-world case study.
Yes, you are reading that number right, $8.5 million. This is the sheer scale of the live Solana swing trade discussed by Trades by Sai in the source material. It's totally staggering. But you know what's truly fascinating? The execution of an $8.5 million trade relies on the exact same simple, honestly kind of boring rules we've just been discussing. There is no secret magic formula here. There is only the flawless execution of foundational principles.
Let's break down the exact parameters of this setup. The asset is Solana. The vital line in the sand, that key level was 192. Buyers previously had total, absolute control above 192. But once that support was broken and the price slipped underneath, the entire psychological and technical structure of the chart shifted. Sellers were suddenly in the driver's seat. The initial bearish target was 173, with a secondary, much deeper macro target of 150. Once that 192 level was breached, the setup became a heavy, mathematically logical sell.
Tracing the chronology here is where the concept of the correction really shines. So, about a week prior, that crucial support at 192 was broken. Boom! The entry happens because sellers take clear control. Then we see the initial movement, this heavy sell-off, driving the price rapidly down to that first target of 173. But then, the market does what the market always does. It corrects. Price pulls all the way back up to 192. Now, an emotional trader, they'd completely panic and close their massive position right here. But remember our rules. Price pulled back to 192, but it did not break above it. The lower high held. The trend was not invalidated. And because the trend wasn't proven wrong, the swing trade is confidently maintained, aiming straight for that deeper 150 target.
To quickly summarize this absolutely massive trade, first, relying on higher timeframes, specifically the 4-hour chart, filtered out all that choppy intraday noise and fake outs that scare away amateur traders. Second, strictly using the lower highs protected the strategic stop loss. If 192 didn't break, the trade simply stayed open. Third, because the positioning was crystal clear from the very beginning, emotional FOMO was entirely eliminated. Look, holding an $8.5 million trade sounds terrifying, but when you combined dedicated risk capital, smart tactical positioning, and a rigid mathematical invalidation rule, it becomes entirely, coldly logical.
I really want to leave you with this final thought to reflect on before you take your very next trade. Are you positioning yourself for options and power, waiting for the absolute best setups with a clear, calm mind? Or are you the person at the party, trading out of desperation, forcing setups to try and pay this week's bills? Mastering the charts always starts with mastering yourself. Thank you so much for joining me on this explainer. Keep learning, keep positioning yourself for success, and I'll catch you on the next one.